Hello. Hopefully, you can see me. I shall stop sharing the screen. Hello, Jason.
Hello there.
Welcome, everyone, to what will be a wonderful day of options education. I must tell you 3 things before Jason can tell you many more than 3 things. First, this is part 1 of an education series, so this will be for beginners. Our education series will play out about every 2 weeks in 4 parts, with webinars like the one we are on today. And the next one will be on Thursday, March 17th. In 1 week, we will have a how to use Trade Machine webinar, which will dive into the guts of the platform. I shall lead that webinar. You will get an email. It will be in 1 week from today. And finally, this will be a rather formal presentation and an open Q&A for a little bit. Jason Hitchings will be the presenter today, and I will be in the background, perhaps trolling him in real time. So who is Jason? This is a good question. It's a question I think about many times. Jason is our Chief Technology Officer. He is the architect and developer of Trade Machine. That means every single line of code is his. He started in financial technology in the options world about 16 years ago. For anybody that cares, 16 is one of my favorite numbers. He worked with option pricing models to push high speed and accurate option computations at about 200,000 per second into software that is now owned by SIBO and is resting on hundreds of market maker terminals right now. His option trading training was from option market makers, and in fact, one of his mentors was a senior option market maker that I used to make markets with on NYSE Arca, and that guy actually shaped bits and pieces of my trading style. Not necessarily a valuable piece of information, one you now know. Jason is one of the most talented computational finance mathematicians I know, and it is our great privilege to have him as our CTO. Today, however, he's not acting as CTO, he is acting as the host and presenter for you. Without further ado, Mr. Jason Hitchings, you may go.
Great. Thanks, Sophia. Thanks for the introduction. Let's see here. I'll share my screen. Thanks, everyone, for being here. So as Ophir mentions, today is going to be about the fundamentals of options. The expectation is that you have some trading experience and in the stock world and sort of limited trading experience in the options world, or just want a refresher. So before I get into that, let me just go through the legal disclaimers. This is not a solicitation to buy or sell any security ever. This is not advice. You should read the characteristics and risks of standardized options. The results here are provided for general information purposes as a convenience to the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. Only risk capital should be used when trading futures or options. Investors could lose more than their initial investment. Past results are not necessarily indicative of future results. The risk of loss in trading can be substantial. Carefully consider the inherent risks of such investments in light of your financial condition. Okay, so this is our agenda for today. Broad strokes, we're going to start off with a metaphor instead of a bunch of option definitions. And we'll pick up on that metaphor in future classes. And we'll kind of keep enriching it and making it more useful to understanding options trading. Then we're going to get into understanding some of the kind of core aspects of trading options, the effect of time, the effect of buying an option at various strike prices, we'll go into a few trading plans about when you'd want to buy a call, when that makes sense. We'll look at selling calls, and then we'll move on to puts, and then we'll have a Q&A at the end. So again, the expectation is that you have had kind of limited options experience, or that you just really want a refresher, or that you just like to consume everything Trade Machine puts out. If you feel super comfortable with options montages, you understand the effective time on the price of options, all that kind of stuff, then this will be just a pure refresher for you guys. Okay, so let's start with the thought experiment. And our thought experiment is going to be about if we're going to buy a safe. And so here's the scenario. There's a restaurant. The restaurant always makes between $500 and $1,000 a day. Some new owners come in and they just want to just sell off a bunch of things at the restaurant, and they're just going to sell the contents of the safe because they don't really care that much about what's in it. You're going to get the contents, not the safe. They're going to give you a key. It's going to have between $500 and $1,000, and you know that you can trust everyone involved. You know, they're not going to rip you off. So feel free if you want to. I'll kind of keep an eye on the chat. So as I pose, questions, I'll kind of answer them as we go. If I see people responding to questions as we go, I might choose to chime in with one of those. So the question is, what's the safe worth? There's somewhere between $500 and $1,000 in it, but what's it worth? So one question becomes, well, what's a normal day for the restaurant? Because a normal day could look a little different. There's between 500 and 1,000, but that might look like $600 with some days closer to 500, some days closer to 700, and rarely having days out here. Or it could be the opposite. You could have a ton of days where they're collecting around $900 and very few days on the low end. For right now, let's just assume that there's a nice, clean, what you'd call a distribution of how much money is in the safe, and that it's centered around 750. So now with this information, what would someone pay? So you can say a few things. You're expecting there to be about $750 in the safe. There's not more than 1,000. There's more than 500. So if you can get the safe for less than $750, you're expecting on average to make some kind of profit. If somehow you can buy the safe for 500 or less, you're guaranteed to lock in a profit. And likewise, if you're buying the safe for $1,000 or more, you're making a terrible decision. So in the options world, you spend a lot of time looking at what they call P&L, profit and loss charts. And so I just wanted to use this safe to give you an introduction into those, since we'll be using P&L charts a lot in this video and going forward. So the numbers on the bottom are theoretical amounts inside the safe, where we don't know, but we're going to map out different theoretical possibilities. And this line is the break-even point in making money. Anything above it, you're making more money. Anything below it, you're losing more money. So for the purposes of this little thought experiment, let's just say that you could buy the safe for $600. Question is, how much do you make depending on how much is in the safe? Okay, well, what's the best case scenario? The best case scenario is that there's $1,000 in the safe. It costs you $600, you make $400. What's the worst case? Well, we said it's around $500. And so in that case, you're out $100. Let's just fill in another price here. So this ends up being your break even. There's $600 in the safe. You paid $600. All very straightforward, but this will be useful later on. And if there's some random amount of money in the safe, like $857, then you've made $257. So this is a really basic profit and loss chart. It goes up and to the right, and you can map a line onto this that tells you essentially a function or a formula for how much you're going to make over time. So let's take this make it a little more interesting. And let's say that you could only have the money above $900. Now what's it worth? Well, that's a pretty challenging question to answer, because we know it's going to be centered around 750. We know a theoretical best case and worst case, but how do we know how often there's more than $900 in the safe? It could look like this. Everything's still true. It's still more than 500, less than 1,000, still centered around 750 if this is how the days are spread out in terms of the likelihood of having certain amounts in the safe. Or it could be much more variable. The restaurant could just have a single client where they cater a lunch for a big business, and they could make exactly $750 every day. And having the right for all the money in the safe above $900 could be completely worthless. Or it could be something very different where a decent amount of the days there's more than $900 in the safe and it has real value. So clearly, if you're looking at these two shapes of charts, you'd want the one that has this bigger spread. And what would you call that? You know, in statistics, you might call it the variance. And just in everyday terms, you might call it the variability or even the volatility of what's inside of this. So you'd say this is kind of a low variability and this is a high variability or high volatility. So when you have the right to buy something and there's no downside in owning that right, then volatility is actually a positive things in terms of figuring out the value of that. If you're managing a big fund and you're trying to invest in the market, oftentimes the performance of the fund is actually ranked against how little volatility there is. If you're buying a stock and the stock is going to go up $2,000 over the course of the year and you spent $10,000, you don't want the stock to be fluctuating between 0 and $20,000 throughout the entire year just to make $2,000. That would be a very stressful year. But in this world, when you are having the right to buy an asset, that volatility is actually worth a lot because it creates a range of options and a range of possibilities. And you have the possibility of capturing the best case scenarios within that. Okay, so let's relate this a little bit more to options. And so just kind of a vocabulary quiz for some of the equity option terms, let's just kind of look at this and kind of map these terms to the options world. So the money in the safe is the what? On the right-hand side, is it the delta or the exercise or the expiration or and the right to buy without the obligation? So the money in the safe is what you call in the options world, the underlying asset. It'd be kind of like the stock that you're buying. And the right to buy without the obligation would be a call option. And the price above which you can take the money, 900 in our example, would be the strike price. And if the safe is opened and it's found to have $840 in it, your option to have the value above 900 would be considered to be, and the term is out of the money for that. So this is just kind of the way that we're using this metaphor. But there's something missing, really important piece to this puzzle that we're missing. There's a lot of subtleties that you're missing. We're not talking about interest rates or other things like that. But a really big factor that we haven't put into this so far is time. In our scenario, we're just have one day to buy, to get the contents inside the safe. In the options world, typically you're having the right to buy or sell something in the future. And that's a really important component of the value of the option. So just for this analogy, let's say you could just sort of see what's inside the safe, and every single day for a week, you could choose whether or not to use your one-time right to get the contents of that safe. Or if you could do that anytime for a month or anytime for a year. Obviously, the longer you have to make that decision, the more chances you're going to have to get the value that's closer to the maximum. And so the longer you have, the more valuable that becomes. In the options world, you refer to that as the time to expiration. It's the time until your right expires. So if you wanted to dive into just the pure definition of a call, this is it. It's pretty dry, but call options give you the right to buy without the obligation an underlying asset. We're going to be talking about the stock today at a specified price within a specified period of time. It's called a call because you can call the asset away from someone, and whatever you're able to call away is called the underlying. In our world, it's a stock or an ETF. So a call option is giving you the right to buy a stock, and each different price that you can buy at, whether it's buying at 10 or 100, those are called the strike prices. And each call lasts some certain amount of time, and that's the expiration date or the duration or the maturity. So just looking at a simple example, this would be, it says April 14, 2022, 170 Apple call, and that would give you the right to buy Apple at 170 anytime between now and April 14th. There are other styles of options, but these are the quote unquote American style of options, and you can use it at any time. So I'm just pulling up a montage here, an options chain from Thinkorswim, and just understanding how to read this. The call options are on the left. The put options are on the right. We'll talk about those later. These are the expirations. So this is the time you have to buy this thing. These are the strike prices. So this is the price that you're buying or selling at. And then I'm going to zoom in a little bit. And so right now I'm just looking at 1 month's expiration. And we see this is for the 14th of April. This call option would give you the right to buy Apple at 145. This one would give you the right to buy Apple at 150, 155, etc. So the example that we gave was the 170. That's this line here. This is the last trade price. That's how much the option changed on the day. This is the price at which the market will buy it, which is the price that you would sell it for. And this is the price that the market is asking, which is how much you would pay if you were looking to buy it. So in this case, it says if you were buying this, it would be $3.90 a share. But it's important to keep track of the fact that this is almost always for 100 shares. Aside from some special situations, if there's a merger or something like that, options give you the right to buy or sell 100 shares, but they price it per share of stock. And so if it says $3.90, it means $390 plus any commissions. It's a little bit of a convention to get used to, but it's actually quite useful to price things on a per share basis. And we'll kind of get into why that is later. But I just wanted to for people that are really brand new, just kind of walk you through what that looks like. Okay, so we didn't talk about time in that safe, but let's just dive into some examples and try to understand why time has such a big impact and kind of how that relates to how much the stock itself moves. So we're going to invent a fictional company. We're going to call it Safeco, SFCO. That ticker isn't listed as far as I know. If it is, it's just a coincidence if it's listed in some Canadian exchange. But in this scenario, you have the right to buy 100 shares and you can buy at $9. How would you decide what that is worth to you? Stock's at $7.50, you have the right to buy it at $9. So in the options world, what would you call these things? The underlying value, the current underlying value, that's the stock price. And the strike price is what? That's the price that you have the right to buy it at. So at this point, can you say what this is worth? Not really. If you're going to buy the stock today at $9, doesn't have any current value because you can buy it in the market at $7.50. So we need more pieces of information. And so in terms of like what it's worth now, nothing. You know, buying a soda at $5 if you can buy the soda in the machine at $1 doesn't have value. But let's go back to this kind of theoretical chart and talk about what's this option going to be worth at different values of the stock. Now, this isn't strictly a P&L chart because we're not talking about what the option cost us yet. So we're just looking at what the value in the option is at various scenarios in the future. So if on expiration day, the stock is at $5, that doesn't have any value to your 9 call, because being able to buy something at $9 that you can get for $5 has no value. So that's true of 6, 7, 8, and 9. Because again, if I'm just offering you the right to buy something you can just buy on your own, that also doesn't have any value. But once stock is up at $10, now all of a sudden I'm saying I can get you something for 9 that it would cost you 10 to get elsewhere. Not only that, I can buy it for 9 and I can sell it for 10 in the market. And so I can make $1 per share if the stock goes up to $10. And I'm doing that for 100 shares. So now the value of that option is $100. And for every dollar that it goes up, I'm getting an extra $100 of value out of my options contract. If the stock ends up at 50 somehow, then you have $4,100 of value tied up in it. Okay, so now we've seen kind of what some different valuations look like. But one question is how long does the stock have to get there? So it might have 10 days or 30 days or 82 days. If you knew that you had 30 days, would you know how much this option is worth? There's still a lot you don't know. So a really central question is, well, how much does the stock actually move? So in this scenario on the left, we're seeing the stock kind of staying in a pretty tight range between 6 and 8. In this other one, it's whipping around all over the place. Now, if you have the right to buy the stock at 9, it looks a lot more attractive for the stock on the right. And so in the stock world, what do we call that? The main term used to describe that is volatility. So there's a connection between how much the stock is moving and how long you have to make a choice. And we'll get into some of the more technical aspects of this more in future classes. But let's just look at a few charts and a few timelines. So with this chart, if you're just going off your gut and trying to figure out what this option, this 9 call is worth when the stock's here at 750, if you have a day or if you have 4 months, your instincts just tell you, obviously, this is the chance of it ending up above here is a lot better with more time. But look what happens when we just make the stock less volatile. All of a sudden, the right to buy this option or buy the stock above 9, even 4 months out, is seeming quite unlikely. Here's another scenario where it's really volatile, where you could imagine really anytime it starting to come above that 9 level where you start to see some value in it, even in the short term. And I just doubled all the numbers on the left here. So now it's at 20 or 15 or 10. So the chance of this thing hitting 9 soon, even within the next week or so, seems pretty reasonable. So when you look at a chart like this compared to a chart like this, you can start to see that the amount that the stock is moving and how long it has to move, that there's a pretty important connection between the two things. And this is presented largely to help us develop instincts around a stock's volatility and how that affects the value of an option and how that's related to time. And then we'll get into more technical aspects of that as we go. So now we have a lot more information. We say, okay, the current underlying price is 750. We have the right to buy it at 9. We'll just put a number on the volatility. We'll say on average, the stock moves 51% per year. And we'll say that we have 27 days to make our decision. So now at least we could come up with a gut estimate for what we think this thing might be worth. But it turns out once you have this much information, you can do better than your gut. You can actually turn to some math, some option models and statistics that will help you just determine what are the actual chances of this happening according to the math if we plug in these assumptions. So let's do that. So here's just a random options calculator online. It's no better or worse than others. I've hidden some of the complexities. I did plug in an interest rate assumption here. When you plug those assumptions in, what the options calculator is telling us is that this option is worth 5 cents per share. Okay, so 5 cents, but it's 5 cents times 100 because it controls 100 shares. So they're saying that this option that we just talked about has $5 of value in it in terms of what the option models think is a fair price for this thing. Okay, so 27 days, it's about a month. So you're saying the calculations, the statistics are saying that this theoretical stock, that if you spent $5 on the chance of this stock going above $9 and capturing all the value above $9 between now and a month from now, that would be a break-even investment. At $5 is about what this is worth. So now as we're trying to understand the effect of time on the value of an option, let's ask ourselves the question, what is this option worth 4 months from now? The intuitive answer might be, well, it's 4 times as far away, so it's worth 4 times as much, which would be $20. When we plug it into an options calculator, though, the options calculator says it's worth 36 cents per share. So that's like 7.5 times the value at 4 times the time. So that's curious. What if you do it in the opposite direction? What if you say, okay, it was 5 cents a share when it was 27 days out. So what if it's 4 days out? Is it about like 1.25 cents roughly? Something like that? A little more than maybe 1 1/3 cents per share. And when you plug that in, this is an old picture, but it actually comes out to 9 cents per share, which is only about 1/6 of the value. And when you map this out over time, all these different durations, this is the way the prices change. So when you look at this chart, it feels fairly intuitive. It's going down over time, and eventually it's going to reach 0. Again, having the right to buy the option at $9 if SFCO is trading at 750 doesn't have value. So this thing is going to 0. But there's something subtle going on that I want to bring your attention to, which people that have traded options in the past have experienced firsthand. If instead of looking at this chart in terms of total dollars, you start to look at it in terms of percentages, the picture looks very different. You see that as a percentage, so this is the amount of time remaining to the right, and this is the amount of the percent value retained. And you can see that this thing is plummeting. So we're looking at these 10-day increments for how much is left in it. And in the first 10 days, the thing goes down about 9% in value. But from day 20 to day 10, look at this. It goes from being worth $2.80 to 40 cents. in terms of the total option value. So this thing has it's gone down 86% in value in that last 10 days. So it's a really important thing to understand about the nature of options and the nature of the math involved in options is that this value that you're looking at, that option that you're owning, it's not going to, if the stock's not moving, you're not going to see a lot of change at first, but it's going to plummet towards zero and it's going to catch up to you quickly. So when you own the right to buy a stock for more than the current stock value, this thing's going to move towards zero very rapidly. Time is not your friend. And so it's something to be very conscious of as you own options. Anytime you own option, your option is going down in value every day that passes, but those out of the money options will really plummet. We'll look at some in the money options later on. There are ways to manage this risk with spreads and other things, and we're going to talk about those in upcoming classes. But here's a question for you. If you're buying a long call in this kind of scenario and it goes to zero, does that mean that the trade itself was a bad trade or a bad idea to start with? So let's look at it in terms of rolling a dice. If you're going to roll a dice and it costs you $5 to roll it, and if it lands on a 6, you get paid out $50. That's a pretty good bet. You get a 10x return and you're going to win 1 in 6 times. So that's a good bet. Now, if you roll the dice and it came up with a 2, did you make a bad decision to roll? And this is a pretty important concept in trading, especially in trading options. If you're trading an out of the money option, it's going to plummet towards zero, but it could have been a reasonable risk reward anyway. But an important takeaway is if the way that you decided to roll this dice is you put everything in your bank account and you mortgage your house and put it all in one roll, then yeah, that's a bad decision. But if you have a way to spread out that risk and take that roll, 10 times, 100 times, this is going to work in your favor over time. So it can still be a great decision as long as you're managing the size of the actual positions and the bets that you take. You want to be taking bets where you have some edge, and that edge only plays out over time. Okay, so let's start talking about not just what the options value is, but let's start talking about the profit and loss in this scenario. If you're buying an option, if you're buying a call, can you lose more than you put in? Basically, no. If you're long a call, or we'll talk about puts later, and all you're doing is buying the option, you can easily lose 100% of the option's value. But that's the limit of your losses. And that'll be your worst case scenario, and we'll talk about when that occurs. So if we're going back to this example where you're buying this 9-strike call and you're spending 40 cents a share of $40, how much do you make or lose if the stock stays at 750? It has no value at 750 to buy it at 9, so you lose 100%. And what if the stock goes to zero? Well, it has no value to buy it at $9 if it's at zero, so you still lose 100%. So now the next question is, what price does this Safeco company need to hit to break even on your trade? So you spent $40 to buy 100 shares at $9 or above. What's the price that the stock needs to be where this trade at least broke even? So for every penny above $9 that this company goes, you can buy 100 shares and you can sell it back immediately to the market for $9. So if it's at 901, you can buy it at 901, sell it back at 9, and you make $1. You still spent $40, and so you still lost $39. So what you needed to do is to go 40 cents above $9 in order to be break even to cover your initial investment. This doesn't factor in commissions. It doesn't factor in, the bid-ask spread in the market, but that's a topic we can talk about more later. But basically, the stock needs to go to about 940 or a little above in order to break even. So how much do you make if the stock goes to 12? Well, now you can buy it at $9 and immediately sell it back in the market for $12. So the options value at that point is $300, and you spent $40 to have that, right? And so you've netted $260, which on initial investment of $40 is a nice percentage return. So when we look at the profit and loss chart again, this is how that maps out. You've lost your entire investment from anywhere from $0 up to $9. And then you start making it back at $100 per dollar it goes up. But you still have that initial $40 to cover. And the higher it goes up, the more money you make. So if somehow this teeny stock gets up to $50, you make $4,000. So obviously, extremely unlikely scenario. So let's talk about what that intrinsic value is, what that real money is in these options over time. It's in understanding the value of an option, it's one of the important components. So far we've been talking about buying options that were where the right to buy it was above the current stock price, that had no current real value. But you're hoping that by expiration day, that there be some real, true, inherent value in the stock. And that's what they call the intrinsic value. It's how much value, if you wanted to use the option right now, that it would give you. And so you can see the intrinsic value is going up. At $10, you have $1 of intrinsic value per share. At 11, you'd have $2 for that same 9-strike option. So if you own an option that has real value right now, there's an expression for that in the options world. When it has real money right now, they call it in the money. There's another expression for options that don't have value right now, that you can't use them to buy the stock at a cheaper price right now. And those are called out of the money. And then there's one more special term for that option right there. Basically the option or two options that are closest to the current stock price if the stock was at 9. And those are called at the money options. So let's go back to our option montage, or the options chain. We're looking at Apple again. And this is from Thinkorswim. So what you can see is that Apple is trading at 163. So every time you have the right to buy Apple at less than 163, they've added this sort of purple background to it. And that indicates that these are in the money options, that they have real value right now because you can buy the stock at less than the current price. Their 163 is pretty close to 160 and 165. Technically, the 165 would be the at the money because it's a little closer. But oftentimes, the two closest options, if it's pretty close, would be called the at the money options. So in this scenario, the 160s and the 165s are sort of the at the monies in the options chain. Okay, so we saw before the way that when you're buying this at the money option, the way that the value plummeted, just went towards 0 very rapidly over time. So how does that picture look different if instead of having the right to buy something at more than it's worth, if you have the right to buy it under its current value, where it has intrinsic value? So this is what that chart looks like if you plug it in for a 6-strike option for our theoretical company when the option's at 750. Assuming that the stock price doesn't actually change, but this is the number of days you have left. And you can see that as the days approach 0, the value is coming down, but it never drops below 150. That 150 is what we were just talking about. It's the constant real value, the intrinsic value in the option. And that value won't go away as long as the stock's at that price. So in a lot of ways, it seems like this option isn't as expensive to own, or it doesn't decrease in value as much. And that's true. The total value of the option has a lot of inherent intrinsic value to start with, and so the total value of the option isn't dropping as much. But there's this other component of the value. So you have the intrinsic value, the real money that you can get out of the option right now, and then you have this other value, which is from the probability, the chance to capture stock movement over time. And that term is referred to as the premium or the time value. And that's how you arrive at your options value, is it's a combination of the premium and the intrinsic value. So the premium will go to 0 by expiration. The intrinsic value will remain in there as long as the stock is at the same level. So if you can buy the stock at less than the current value, if the strike is below the stock price, that intrinsic value will stay in the option. It's not affected by time. But if you just look at the premium in the option, the time value in the option over time for both the 6 strike call and the 9 strike call, you see that the time value is plummeting towards 0 for both in a very, very similar shape. And so that's an important thing to understand about these options, that while that intrinsic value may not be changing, you're still paying basically the same time value to own options that are an equal distance away from the stock price. Okay, so now we've talked a little bit about some, things affecting the options value, a little bit of intuition around stock movement, volatility, the strike prices, that kind of thing. But let's just talk about when you'd buy a call, when that makes sense for your trading plan. So first, just a simple question: is buying a call a bullish or a bearish bet? Meaning, do you want the stock to go up or do you want it to go down? You want it to go up, because if you have the right to buy it cheap, you want that thing to get expensive, because you can buy it cheap and sell it for more. Okay, so let's talk about some reasons to buy the call. So you can speculate on the stock price, meaning you can hope that the stock price goes up. You can also speculate on the options price, or essentially hope that the assumptions that the market is making about the amount of volatility in the stock will go up. We're just going to touch on this very briefly today, because it's a big topic that we'll hit on later. And a third reason to own a call option is you can get some leverage, kind of like buying on margin. So let's just talk about, quote unquote, speculation. You're hoping that the stock goes up in value. So 2 choices if you want the stock to go up in value: or you can buy a stock, or you can buy calls. There's other ways to bet on a stock going up that we'll talk about later on. If you're buying a stock, you don't have a lot of time pressure. You could be hoping that the whole industry improves. You could be making a bet on the management of a company. But the only opportunity cost for owning a stock is essentially, what else could I be doing with the money? Could I be going on a vacation, or could I be putting it in a bank and earning some interest on it? But you don't have nearly as much time pressure when you're buying a stock, especially if you're not buying it on margin. When you're buying a call, on the other hand, you have to not only be right about the direction of the stock, but you have to be right about the time. And as we saw, that the options, especially if you're buying an out of the money option, that option is going to go to zero value by expiration, and it's going to start accelerating. So if you have a hunch about a company or a drug that's going to get released or something like that, and you think the stock's going to do great, and you buy an option that's going to expire in 14 days, if the stock does nothing and then it doubles after 15 days, you still lost 100%. So you have to be right not only about what's going to happen, but when it's going to happen. And that's part of the challenge, especially if you just are owning an individual option, what they call a naked call. That's one of the reasons that within Trade Machine, and next week on Saturday, Ophir is going to give a nice in-depth run through of what Trade Machine is and how to use it. But there's a good reason that for the top 6 strategies listed on the Trade Machine Today tab, that 5 out of the 6 are spreads, because spreads allow you to manage a lot of this risk in different ways. Now, it doesn't mean that buying a call can't be great for you if you do it right. And I think that draws a lot of people into buying calls or out of the money calls, because there is the potential to make a huge return. And so here are different ways that the option has moved over time. So in this, what I'm looking at here is if you bought, so stock is trading at 10 in this theoretical scenario. If you bought a 6 strike call, so this is in the money, or 7 or 8 or 9 or 10. So all these are in the money. This 10 is at the money, and these 11, 12, 13 are slightly out of the money. If you bought it when there's 14 days left, and the stock goes up $2 within 7 days, so the time value is starting to drop in this option because you've cut your time in half, and the stock has gone up 20% in value. So look at what's happened to the options here. So this in the money 6 strike option has gone up 50% in value. So that's what I was talking about when referring to buying an in the money option can be a little bit like buying stock on margin. It's almost like you had a 2.5x margin. Now, when you start talking about these more out of the money options, your initial investment is much lower. The chance that you lost 100% of your investment was much higher. But in the scenario that somehow the stock did move the direction you wanted it to in the time frame you wanted it to, you can see that the returns can be massive, and that's what draws a lot of people into trying to buy calls. But as mentioned with rolling the dice, when you're buying an out of the money call, you need to go into it embracing the fact that you, the most of the time, will lose that money. And there's nothing wrong with that as long as you're managing that decision correctly. Now, one other caveat is that option markets have width. And so the chance of being able to really buy this thing at 2 cents, for most options, you couldn't. It'd be 0 at 5 cents, meaning the market won't buy it from you and you'd have to buy it from them at 5 cents. So getting a 2 cent option for most stocks, the markets are too wide for that. As Ophir will tell you, most successful, experienced options traders are not successful, experienced option traders because they trade naked calls. They do much more complex strategies. There are times that it can be a reasonable approach. When I was first getting started in options trading, where I had a couple years of experience back in the day, there was a big recall in Toyota because there was a lot of concern about the brake pedals. I don't know if any of you guys remember that, but the stock was getting absolutely crushed. And it was getting crushed for a long time. And so a strategy that has worked for me. Not that my trading experience is the most important thing, but occasionally there'll be a company that's a very good company that gets some bad news. And if the market way overreacts, it's still an extremely risky trade. But that's the kind of scenario that someone could consider, taking a risky bet and trying to profit from it. Same thing, you could do that with spreads and take a lot less risk. A lot of people will buy calls going into earnings events. This can be done, but just understand that there's thousands of algorithms and prop shops and hedge funds and traders trying to do the same thing. And whoever is selling you that option is selling it to you because they think they're selling it to you for more than it's worth and that it's unlikely to come about. So you need to have a lot of conviction and have some kind of insight that the market doesn't if you are going to speculate that way. So in addition to trying to hope a stock will go up in price, you can also benefit from market volatility when you own options. So if the market starts to think that there's going to be a bunch of new volatility coming in, then the options will go up in price just because there's a bigger range of motion that the stock could cover. Typically, you wouldn't just buy a one-sided option in that scenario. So you do, something called a straddle, which we'll talk about later. But one thing that can happen is even if the stock doesn't move, that the expectation of future movement can change, and that can be a benefit or it can hurt you. But that is one way that your option can go up in value. And we'll talk about volatility and implied volatility more in different classes. And then you can get leverage. And that was kind of an example that we saw with that buying that in the money option, that it went up 50% in value and the stock went 20% up in value. So you can either buy stock on margin if you're looking for that kind of leverage, or you can buy an in the money option. And there's times that what you would pay to own that option might even be less than you'd pay for your margin interest at your brokerage. Okay, so we kind of touched on a lot of topics around buying a call. So let's think a little bit about selling calls. So if buying a call gives you the right to buy 100 shares of stock at a certain price for a certain time window, then what does selling a call give you? Well, it gives someone else the right to buy your stock from you within that same, at a certain price within that same kind of time window. So one question becomes, well, what if you don't own the stock? Now, there's a pretty good chance if you don't own the stock, if you don't have enough option privileges, that your brokerage won't let you sell a call. But let's say that you do have the appropriate amount of privilege, I think it's options level 2 to do that, then, or that's actually probably 3 to sell a completely naked option. So what happens if you sell a call, that call ends up in the money, and someone says, hey, I want to buy your stock. So the stock started at 750. You sold a call for 9, and the stock goes up. But you didn't actually own the stock. What your brokerage is going to do is it's going to sell the stock anyway to that person. You're going to have to honor that agreement. And they're going to track it in your portfolio as you shorting stock. So if you sell a call and the call gets exercised, if you don't own the stock, you're going to have essentially minus 100 shares in your account for each contract. So let's look at this for a second. So let's say you sold 5 contracts of a 9-strike call, and then it goes up to 1050. What actually happens in your account? Well, the person has to still give you $9 per share. So your account will have $4,500 extra in it to start with. But you had to come up with a stock, and so they're going to go buy the stock out on the market and sell it to the person and credit you with a short stock. So what price did you actually short it for? Did you short it for 9? You shorted it for the market price. The market price at the time was $10.50. So what you did is you went out and you bought the stock for $10.50, and then you immediately sold it for $9. And so what did this whole trade look like for you? Well, when you bought the stock for $10.50 and you sold it for $9, you lost $1.50 per share. And you had to come up with the, money to cover the original purchase. And then you got credited with some money back. But you netted being out $750, the difference between those two. But $750 isn't the whole story. It's not your P&L. It's the amount from that last final piece of the trade. When you sold that call, you collected something for it, and you collected 40 cents per share. And you did that times 500 shares. So that ended up bringing in $200 credit from selling that originally. When it got exercised, you lost $750, and you ended up with a P&L of minus $550 because that stock went up. So this is an important question to ask yourself when entering into any kind of options trade. Is like, let's walk through each of these. These are pretty fundamental tenets of trading options. You'll ask yourself the same questions when you're trading spreads and doing more complicated things. But let's look at what's your best case scenario. What does your position look like if the stock ends up right at your strike price? What's your worst case scenario, and what's your break-even price? So what's our best case scenario if we're just selling a naked call? So if stock's at 750 and you're selling the 9 call, what do you want to have happen? Well, you're going to want the stock to not go above 9, right? Well, I'm going to dive into all the answers in a second. Okay, and what's your P&L if the stock stays right at $9? Well, at $9, the person's still not going to exercise the option, so it still doesn't have any value. So that's still that original amount of money you collected. What's the worst case scenario? Well, the stock can go infinitely high, and so there's not really a worst case scenario. And so looking at this original 5 contracts at 40 cents, your break even, you collected $200, but every time the stock goes up a penny, you're starting to lose that money back at $5 a penny. So your break even is at $9.40. So even though there's $200 here, that kind of thing, it's quite easy to figure out your break even because it's simply the strike price plus the price per share of the option will end up being the break even. Okay, so these are a bunch of different P&L charts at a high level without any of the actual numbers showing. And these are all different trades and spreads that you can do in the market. But just to get sort of a conceptual understanding of these things, let's figure out which one of these is the right one for selling a call. And let's kind of start eliminating the ones that we know are not right. So again, all of these charts, as your profits go up, you move up on the chart. And as your losses go up, you move down. These are the break-even points. And stock is moving on the x-axis. So when stock goes down in this direction and stock goes up in this direction. And so when you're shorting a call, do you have limited or unlimited upside? And so the pictures that have unlimited upside will have a line that's going up. And it could be going left or it could be going right, because upside means profits, unlimited profits. And so a bearish position could have unlimited profits this direction. A bullish position is going to have unlimited profits in this direction. But any of the lines that have a cap where they go flat, no longer, then that means the upside is limited. It means the profits are limited. And so when you're selling a call, all you're going to make is just the initial amount on the call. And so you have limited upside. So we need a line that's flat on the top. So we can eliminate these two. When you're selling a call, are you making money as the stock goes left or the stock goes right? Do you want the stock to increase in price or decrease in price? Well, if you sold the 9 call and then the stock goes to 10, then you're going to be losing $1 per share on that trade. And so when you're selling a call, you're doing better when the stock is moving down. And so anything that has a movement up and to the right, we can eliminate as well. Now, question of downside, does the red line, if you're selling a call, what's your worst case scenario? Well, your worst case scenario is that stock goes to $1 million and that you have to deliver the stock to someone at $9 a share. And you have to go out and buy it at $1 million a share. So the downside is unlimited. It doesn't have one of these flat lines. So that's where we end up with our short call, because limited upside, unlimited downside, and you do better. It's a bearish position. You do better when the stock stays low. And understanding these charts will be helpful as we get into spreads in future classes. So here's what it looks like if we map it all out. We make our profit of $40 up until the strike price is hit, and then we start losing money. I simplified this to just be shorting 1 call, but if you're shorting 5, it's just 5 times all of these values. And then the stock starts going down for 1 contract at $100 per dollar of stock movement. And if you have 5 contracts, then it'd be $500 per dollar of movement. Okay, so that's what happens with a single strike at various stock prices. So we're talking about the 9 strike here in terms of the profit and loss at various stock prices. But now let's talk about what if you actually shorted a call at different strikes. So instead of saying, okay, the stock movement's variable, let's just say that we know the stock's going to move from 10 to 12. What happens if you sold different strikes? If you sold the 6, 7, 8, 9, 10 strike, etc. So again, this is the same chart we looked at before for being long a call. But now these are all losses because the option moved up, the stock moved up in value. Had it moved down in value, you would just collect your initial amount. You'd collect the premium. You'd collect the time value if it moved down in value. When it moves up, you can see that this thing can move drastically against you. So as attractive as buying this was in the good, scenario that this thing went up substantially, selling it can have a catastrophic loss. So generally speaking, when people sell a call, they don't just sell a naked call, though it does happen. But the more typical scenario is that they're combining selling a call with owning stock to start with, which they call a covered call. So let's talk about that a little bit. So this is what the P&L chart looks like of stock. Every time the stock goes up, your profit goes up and it moves steadily up and right. As we just discussed, this is what shorting a call looks like. You make your maximum below the strike price and then you start losing money above the strike price. But what happens when you do both of those things at once? So let's just ask ourselves the question, the kind of basic things you should understand before entering into an option position. So what happens if the stock goes to 0? What happens if it goes to 1,000,000 or some high value? And what happens if it ends up right where the strike price of the option is? So if the stock goes to 0, when we now own stock at $7.50 per share, and we collected $40 for one contract, what does our profit and loss look like if stock goes to 0? Well, you spent $750 and that goes to 0, and you have a $40 credit, and you're gonna keep that credit, but you're still gonna lose $710. If it goes to 1,000,000, well, you gave the right to your stock away at $9. So you're not going to benefit above $9. So you make $150 on your stock plus $40 on the call, and then you walk away with $190. Now, what happens if the stock lands right at the options strike price? Well, it's actually the same thing in terms of profit and loss. You make 150 on the stock, you make 40 on the option. The difference is that you're going to still own the stock because no one's going to exercise the option if it's just the same price that they could just buy it in their brokerage. So that's what this picture looks like in terms of the profit and loss for selling this 9 call. You're gonna make some extra money on the stock as it goes up. You're gonna make the $40 on the call, and your profits are capped at 9. But you're gonna keep losing money all the way down to 0. So when you look at these P&L charts, you have stock P&L, you have the short call P&L, and when you combine them, you get this. So when you just kind of do this in your head, you kind of, when you're combining positions, these kind of flat lines don't factor in. You take the upward movement up to this point, and then you have the upward movement of the stock and the downward movement of the short call balance out, and you end up with this P&L chart. So if anyone has questions at this stage on calls, you can feel free to fire them off. Otherwise, I'll just push on into puts. Let's see here. Great. Okay. I'm just going to go ahead and push on to the next section. Okay. Okay, so we're going to talk about 3 different scenarios with puts. The first thing we're going to talk about is shorting, but with a fixed downside. So definition of a put. Here's the kind of boring financial definition. It says a put option is a derivative that gives the holder the right to sell an asset at a specified price for a specified amount of time. Okay, so when you're buying a put, is it bullish or bearish? Do you want the stock to go up or do you want the stock to go down? I want it to go down because you now have the right to sell the stock. And if you can sell the stock at a lower price, then that's where you make your money. So if you have the right to sell 100 shares of Safeco stock at $6 per share for the next 30 days, and the right costs you $10, let's just walk through one of these scenarios. So what's your worst case outcome? If you bought an option, it costs you $10, and the option gives you the right to put stock on someone. What's the worst case outcome? What's the best case outcome? What happens if Safeco lands directly at $6? And what's your break-even point? So if the stock goes up to $1 million, you lose your initial investment, because you're not going to sell someone stock at $6 if it costs $1 million. What's the best case outcome? Well, the best case outcome is it goes to 0 or a penny, where you have the right to sell the person the stock at $6, but you can go out and buy it for essentially nothing. And so you make, $599, or you make $600 minus the $10 that you invested originally, and you end up with, $589 or $590 profit. What happens if this company ends up right at your options strike? You still lose everything because it doesn't have any value at that point. And what's your break-even point? Well, every time this thing goes down a penny, you make $1 because you're controlling 100 shares. And so you need it to go 10 pennies below $6 in order to break even on your position. So here is what our P&L chart looks like. You see that above $6, you've lost your initial investment. And below $6, you start making $100 back per dollar that the stock goes down, up until it hits a value of 0. And you still have that initial $10 investment. And so if the stock doesn't do anything, you're losing the $10. Okay, so let's think about what that looks like if you're combining buying an option when you already own stock. So here's what stock P&L looks like, and here we just went over this is what if you own a put, what does that P&L look like? You make money as the stock goes down. And that's kind of the opposite of the stock's P&L. So if you combine these two things, let's ask ourselves the questions. So you have 100 shares of Safeco at $7.50, and you also bought a put. One put gives you the right to control 100 shares, and you bought the put at $6 for Safeco. So this actually is for $10 here. So it's 100 shares times 10 cents, so that's $10. So you have the right to sell 100 shares at $6 up until expiration. So what happens if the stock goes to 0? You're going to lose between $7.50 and $6. But if the stock goes down further than that, then even when the stock goes to 0, you're going to exercise your right to sell the stock. That's what the put gives you. It gives you the right to sell the stock at a certain price. So you own the stock. The stock's gone down to a penny or $1, but you have the right to sell it to someone at 6. And so you're going to use that right. And you're going to say, hey, I want to go back in time. As if I could go back in time, I want to sell you the stock at $6 because this thing plummeted. And so that's going to put a floor on your loss at $6. So instead of realizing the entire loss of $7.50 down to 0, you're only going to realize a loss between $7.50 and $6. So you're going to lose $1.50 a share. And then you pay $10 to have that right. So you're down $160, which is 21%, but that's a lot better than being down 100%. And what happens if the stock goes to $1,000? Well, you have the right to sell it at 6, but you don't have to use that right. So if a stock goes to $1,000, you're just going to happily watch the stock right up to $1,000. That put isn't going to have any value, but it has very little impact. You're going to make $992 a share. You're going to lose a teeny bit for the put, and you still make a fortune. And what happens if the stock drops exactly down to 6? Well, you end up kind of in the same scenario you did here at the beginning, but you don't actually use the put because having the right to sell it when you could just sell it in the market doesn't really have any advantage. So you're still going to lose the 21%, but you're still going to own the stock in this scenario unless you really want to exercise the option, which you have the right to do, but it would just be the same as selling it in the market. So when you combine these two P&Ls, the stock P&L and the long put P&L, what you see is you have limited downside and unlimited upside. And that sounds pretty attractive. And this can be an excellent strategy for someone that gets nervous owning stock in a volatile market. I've known a lot of people that are stock investors, and they can't tolerate the risk or the feeling of risk and uncertainty in a market. Knowing that worst case scenario, you're going to lose 20% can help calm the mind a lot. And so that can be helpful. When the market's volatile, it's going to be an expensive time to buy that option, but still, it could be better than selling your stock at a big loss. So having that insurance for 30 days cost you $10 on a $750 position. So that's 1 1/3%. So that doesn't seem bad. But it's worth looking at if you did that 12 times in a row. If you did it for a whole year, then you've hurt your stock returns by 16%. And 16% by most standards would be a pretty good year for your stock returns. So if your stock went up 16% and you insured it with options the entire year in this scenario that we're talking about, you'd just break even. So if you do this over the long run, it will definitely eat into your profits, and the closer your insurance is to the current value of the stock, the more it's going to eat into your profits. Okay, let's look at one final scenario in today's class. And that's a way to use a put to do something very similar to a buy limit on stock. So let's look at what selling a put means. So if you buy a put, you have the right to sell stock to someone at a certain amount for a certain amount of time. When you sell a put, that gets reversed. You're giving someone else the right to put their stock on you at a certain price for a certain amount of time. So you're obligating yourself to buy it from someone if they tell you to buy it, the price you've agreed on. So is this bullish or bearish? Well, so do you do better if stock goes down or stock goes up? Well, if someone has the right to sell stock to you, if they can force you to buy stock at a certain price, let's say $6, if the stock goes to $1 and they're forcing you to buy it at $6, then you're going to lose $5 per share on that trade. So in that sense, it's bullish because you do better as stock goes up. So let's ask ourselves the same question. What does the position look like at 0? What's it look like if stock goes up to 100? What happens if stock lands at exactly the strike price? And what's our break-even point? So we're talking now about a $6 strike put in Safeco, and that put we sold for $10, and we collected $10 when we sold that put. Okay, so if the stock goes to 0, then the owner is going to sell you the stock at 6. So you're going to have to buy the stock at 6, but if you want to sell it, you're going to get 0 for it, or a penny. And so you're basically going to lose something like $600 on the stock trade, and you only made $10 for selling the option. So you're going to lose something like $590. If the stock goes to 100 or 100,000, then their right to sell it to you at $6 doesn't have any value. They're not going to use it, and you're just going to keep your initial 10 bucks. If the stock settles at exactly 6, it's kind of the same thing. They're not going to actually use their right to sell it to you, and so you're just going to keep your 10 bucks. In terms of the break even, every time the stock goes down a penny below 6, you're going to lose $1. And so your break even is 10 pennies below 6. So one question is, what's your position going to be afterwards? So if you give someone if you sell a put and they exercise the put, they're going to sell you the stock. When you buy the stock, you are going to end up owning the stock. So this is just a comparison of the P&L from a long put to a short put. When you have a long put, you make money as the stock price goes down, and the reverse is true of the short put. So here's what that P&L chart looks like. You keep your 10 bucks above the strike price, and then you start losing $100 per dollar of price movement below, because you're going to be buying the stock at this price, and as the stock goes down, that's going to mean if you wanted to sell the stock that you'd be underwater. So now let's compare that for a quick second to if you did a buy limit order. So if you said, I want to buy stock anytime it goes below $6, what does that look like? Well, if it goes to 0, you still lose 600 bucks. If it goes to 100, well, you have no profits because you never were able to buy in at $6. At $6, you're break even. And, and that's the situation. So in some ways, it starts to look a little similar to what we just talked about. Except if the stock doesn't move, you don't collect anything. So basically, this is the same chart we just looked at, except it's just down $10 lower than if you just sold the put. It's literally the exact same chart, except everything's just down $10. So the question becomes, well, if I want to do a buy limit order, if I know I want to buy the stock if it goes down to $6, why not just sell a put instead of doing a buy limit order? Because if I sell a put, I collect a little bit of money. And that's a valid strategy. But there are some caveats to it. But when you look at these things side by side, you see that it's the same P&L chart, almost identical, except that you collect a little bit of money for the put. So if you know you want to get in a stock and there's a lot of volatility in it and the options are expensive, and you know no matter how low it goes, you're willing to get into it at a certain price, it's going to be a very valid way to get into it, is to, rather than putting a buy limit order in, you can sell a put, and you'll take a credit for that possibility of getting in. Now, there's a few things that are worth mentioning because they're not identical. When you do a buy limit, if it ever hits $6, you're going to end up owning the stock. And so if it dips down to $5.90 and goes up to $6.50, you're going to buy in at $6 or at $5.99, and then you're going to realize the profits as it goes back up. When you're selling a put, that's probably not the case. If it just dips down and comes back up, you're probably not going to own the stock. So you'll keep the money for selling the put, but you're probably not going to own the stock. Likewise, if someone decides to sell you the stock, they're going to probably do it on the very last day of expiration, and they're only going to sell it to you if it looks bad to them right then, which means short term, if you do end up owning the stock, in the immediate future, you're going to look like you have a negative profit and loss. There's a very tight range where you'll show an immediate profit on the overall trade, but basically you're going to, if you own the stock, it's going to be at a loss. So it needs to be the kind of stock that you know you're happy to own, even if it goes lower, because you have confidence it's going to go up from there over time. One other thing is that if you decide to sell a put at 750 when the stock's at 750 for $6, and then the stock starts going down, if you put a limit order in, you can just change your mind. You know, if the world starts looking a little crazy, you can just get out of that, and it doesn't cost you anything to exit your limit order. But when you sold a put, if the stock starts going down in value very quickly, and you decide, you know what, I don't want to own that stock, it's going to cost you money to get out of that decision, because the option is going to start moving against you. So if you no longer want to own the stock, then you're going to have to buy back that option. That option probably went up in value, and so that's going to cost you something. So they're not identical, but there are times where you have enough conviction in the stock where you are happy to own the stock no matter what the scenario is, as long as it goes below a certain value, and you can get paid to put in that limit order. Okay, so we're basically done now. This whole thing is going to get emailed out. It's all recorded and will be sent to everyone. And I'm just going to do a real quick summary just to kind of help lock it into our heads. So just asking the question, is buying a call bullish or bearish? Once you own a call, do you want it to go up or down? You want it to go up, because then you can buy the stock at lower than the current price. Is a higher strike more or less valuable with a call? Well, you want to be able to buy it at a lower price, so the lower strikes are more valuable. And if you own a call and the market starts expecting more volatility, does that help or hurt you? And the answer is that it makes your option more valuable, so that actually helps you. And does a call have limited upside or unlimited upside? A call has unlimited upside, and it has limited downside. Okay, so same thing for short calls. Is this bullish or bearish? If volatility increases when you're short, does that help or hurt you? Does the short call have limited or unlimited upside, and does it have limited or unlimited downside? When you're short a call, you don't want the stock to go up. If you're short any option and the volatility in the market starts to increase, then the option becomes more valuable, and that hurts you, at least in the short-term P&L, because you sold something that's going up in value. Short calls have limited upside and unlimited downside. Okay, we're just going to do this with puts, and then we're done. So for long puts, is buying a put a bullish or bearish bet? Is a higher strike more or less valuable? If the volatility increases when you own the put, is that good for you or bad for you? And do you have limited or unlimited upside? And do you have limited or unlimited downside? So you want the stock to go down when you own a put. The higher strikes are more valuable because you can sell the stock at a higher price. When you own an option, if the market starts expecting more volatility, that makes the option more valuable. And you have unlimited upside with a put and limited downside. Last one is selling a put bullish or bearish. Does volatility help or hurt you? Do you have limited or unlimited upside and limited or unlimited downside? Shorting a put is actually bullish, because if the stock goes to zero, you're going to have to buy the stock at more than zero. When you're short an option, volatility makes the option more expensive, so you don't want that. You have limited upside and you have unlimited downside when you're short an option. Okay, so that's kind of the end of our real basic introduction to options. We touched on some topics that are very deep and important topics like volatility that we'll go into in a lot more detail in future classes. Future classes will touch on things like spreads and delta and implied volatility and a lot of that great stuff. But thank you all very much for attending. If there are any questions at this point, we're happy to take a few questions. And yeah.
I'm gonna say the number one question by far was simply, when is the second course? So the next course is going to be March 17th. That's a Thursday evening. The next question was, when is the how to use Trade Machine webinar? That is in a week from today. We'll send that out. The next question was, will we get a recording of this? You will. And my favorite slide, which is probably the most valuable, even if people are just investing in stock, was that detailed slide you had on the difference between having a limit buy order versus shorting a put. Wildly misunderstood, overused strategy, selling puts with a lack of understanding of what the differences are. And that slide should save people a ton of money. At the very least, if they are selling puts, they'll know why. So that slide in and of itself is worth, I don't know, $3 million. So we're charging $3 million. No, okay. So that's it. Yeah, most of the QA was straight down the middle. When are we doing this again? I think the questions will kind of start coming in as we get to more advanced options topics.
Great.
And we ran exactly an hour and a half, which is what was planned. So perfectly done.
Well, thanks everyone for attending, and I'll look forward to seeing you all at the next one.
Okay, email's going out pretty soon with the recording. Bye, guys.
All right. See everybody. Thanks for watching part 1 of the Option Education series brought by Trade Machine. All subscribers will get 3 more parts of the education series, in addition to in-depth webinars with option trading experts like Ophir Gottlieb and in-depth analysis of how to improve your trading using Trade Machine. As promised, here is the savings code, YouTube Savings 1. Simply follow the link in the description and enter YouTube Savings 1, or go to www.trademachine.com. Click on the Get Trade Machine and enter that coupon code at the end to unlock this very substantial savings plan. Normally, Trade Machine is over $200 a month, but you can get it right now for $129 per month. Or go annual, and by signing up for a year and committing to a year subscription, you can save much, much more at Get Trade Machine Pro for just $8.99 a month. And you'll have an options platform with proven trading history that has real analytics, real data behind your trades. Rather than guessing, use science. Thanks so much for watching. Look forward to seeing you in the future.